100% bonus depreciation is back. What does this mean for investors? So, we sat down with one of our tax strategists and advisors, Jonathan Walker, to talk about the details and what it means for investors here in 2025. Hi, I'm Ben Brundage with Crystal View Capital. Today, I'm joined by Jonathan Walker, who is a stellar CPA, and we've used him for a number of projects. We've got Jonathan on today because we keep getting a question again and again and again, and it's about the one big, beautiful bill that just passed and was signed into law. So, Jonathan, I'm hoping that you could give us just an overview, maybe of what that bill is and why it might be more advantageous for one of our investors here in 25 opposed to last year.
Yeah, absolutely. And thanks for the introduction, Ben. As part of the one big beautiful bill, bonus depreciation has been permanently extended under Section 168, and so that allows for 100% bonus depreciation on eligible assets that are placed in service, in 2025 and beyond. And so, one small nuance to that is in 2025, the first 18 days are not eligible for bonus depreciation, and so anything placed in service on January 19th or after is going to have full bonus depreciation. And during those 18 days, there's a small nuance, and you'll want to consider that carefully. Before the one big beautiful bill passed, bonus depreciation was tiering down 20% every year, and so 2025 would have been a 40% bonus depreciation on eligible assets. And so it's a significant opportunity for investors and real estate investors to have the opportunity to take accelerated deductions on their property. A lot of the times, in this real estate type, is we're going to have cost segregation studies done, and so a cost segregation study is basically a study that's done to bifurcate or allocate the asset categories between different lives. And so, you're going to break out the cost of your 5-year assets, your 7-year assets, 15, and in a mobile home park, it would be, land in 27 and a half years for any mobile homes. And so it gives you the opportunity to take a lot of bonus depreciation in those initial years. And so it's just it's a huge benefit, or a potential huge benefit to investors, and a way to offset a significant amount of income. Um, you know, there's a lot of other changes as well with the one big beautiful bill, Ben, and some important things to cover potentially for all taxpayers, but particularly business owners and investors. Some of the big high level items that I think would be important for people to know is the salt cap changed, right? And so previously you could only deduct up to $10,000 of state and local taxes if you itemize your deductions, right? And so what they've done now is they've changed that threshold to $40,000, and that cap increases 1% annually through 2029. And so, there's a potential for some additional itemized deductions. Again, there's some nuances to this, and that $40,000 can phase out. And so, of course, always discuss these things with your tax advisor. But that's the general rule, and there'd be a phase out. Some other significant items is they talked a lot about no tax on Social Security. While that is a great way of phrasing it, it's not technically correct. It's an additional deduction. It's not zero tax on Social Security. And so those things, again, can phase out after you meet certain income thresholds. And so you would not get that additional deduction. They spoke about increasing the QBI deduction, but that ended up not getting through the bill. And so that remains at 20%. I think that's important for investors to know. Because real property can be eligible, or real estate businesses can be eligible for that QBI deduction. Not all of them, but in this case, I would think a majority of what Crystal View Capital does would be eligible. Among other things, there's lots of exciting things to talk about. No tax on tips, no tax on overtime. Those are those are interesting tax code and interesting laws. And so again, I would consult with your tax advisors on all of these things, but there's generally allows for an exclusion or a temporary deduction for those income types. One other thing that may be very important for business owners, maybe not in the real estate uh, uh, aspect of business, but is the idea of the research and development expenses. And so they significantly changed that. Previously they were requiring that us R&D costs were going to have to be amortized over 5 years, and so they've changed that law, and now you can deduct them all up front, and there's a potential to go back and amend prior year returns. And then one other very important piece for real estate investors would be the excess business interest expense limitation. This is under code section 163. And so what this is if you meet certain requirements, which are high requirements, you have to have average annual gross receipts of $31 million or more. You're generally going to be subject to this 163J limitation. And so what that means is if you have interest expense, you may or may not be able to deduct all of that. And so in 2024, there was a calculation to determine how much is deductible. In 2025, the same thing exists, except for you can now add back certain things to the calculation, such as depreciation, amortization, depletion, etc. And so those are giving you the opportunity to be able to deduct more of your interest expense if you had a limitation. And so those are some, very high level items. There's a whole lot more to the bill. I would suggest that people, talk to their tax advisors if they have more additional questions. But Ben, do you have anything else that you'd like to go through on this?
Well, that's fantastic. Jonathan, if someone were to say, "Hey, I want to talk in more detail about my specific situation," how could they get a hold of you and your team?
Yeah, absolutely. So you could contact me at my email address, which is jwalker at bdcpafirm.com, or you can call me at the office 702-202-2255. And if I'm not available, feel free to ask for another CPA in my office, or to leave me a message. Those would be the best ways to get a hold of me.
Yeah, Jonathan works with a number of family offices and institutionally focused real estate investors and groups. Really, really great firm over there. For the purposes of our conversation today, this is strictly educational. No tax advice here or anything. So always talk with your tax professional, or call Jonathan and his team up. They'd be happy to chat with you. Jonathan, thanks for your time today.